What's up, dividend investors? If you're on the hunt for undervalued dividend stocks that could potentially skyrocket your portfolio's returns, today's video is for you. We're going to reveal not one, not two, but three undervalued dividend gems to put on your radar this April. And here's a hint, the common thread amongst these three companies might surprise you. So sit tight and let's see if you can crack the code by the end of this video. First up is Williams-Sonoma, ticker WSM, which is a San Francisco-based company that sells home products through brands like Williams-Sonoma, Pottery Barn, West Elm, Rejuvenation, and Mark & Graham. And they offer everything for cooking, dining, and entertaining, as well as home furnishings and decor. They have approximately 544 stores worldwide and also sell their products through e-commerce websites and direct mail catalogs. So Williams-Sonoma has paid an uninterrupted dividend for 16 years. They've been growing it for 13 years, and they have a 10-year 13% CAGR. Simply Safe Dividends gives them a safety score of 80, and that dividend yield is about 21% above the 5-year average and over 200% above the consumer cyclical sector's dividend yield of about 0.97%. And if you buy Williams-Sonoma's shares before April 20th, which is my 45th birthday, you'll receive 90 cents per share. I love to see that their free cash flow payout ratio is only 30%. That is so low. And that $10.30 of free cash flow can easily cover their dividend of $3.60 per share per year. Their sales growth has dropped off quite a bit, and understandably so, all the way down to 5% with the inflation, lingering supply chain issues, and the interest rate increases, meaning people aren't selling houses as much as they used to. But they have been buying back shares down to 69.1 million. And we always love to see that when the shares are going down and the total sales are going up and to the right. And look at that monster return on invested capital of 48%, return on equity of 67%, operating margin of 17%, really stout. And now this is going to be interesting. It shows on Simply Safe that they have a net debt of 40%. But Alpha Spread shows that they have no debt. Seeking Alpha shows that they also have no debt under the balance sheet of long-term liabilities. And the be-all end-all is the company's 10K, which they file with the SEC, shows no debt under their liabilities on the balance sheet. This is just a great reminder that any third-party site can be wrong. When you want to be sure, go to the company's investor relations and look at the 10K or the 8K or any documents that are filed with the SEC. Now, Alpha Spread gives Williams-Sonoma an intrinsic value of $160, so about 26% undervalued. Remember, this is just a range. It's like knowing somebody needs to lose weight, without knowing exactly how much they weigh. And in the worst case, about 7% overvalued, so it's within that range. And there's currently almost 21% of their shares that are shorted, so if the shorts begin to cover, there could be a little bit of a short squeeze going on, which would be great for you if you buy down here. On their earnings call, Williams-Sonoma said that they do see a recession on the horizon. And with the interest and mortgage rates both being up, it's really stunting the home sales. But the existing home values are going up. And when people aren't moving, they will remodel and host more in-home events, both of which are good for home furnishing sales. I think Williams-Sonoma looks like a solid company to consider. Next, we have The Buckle, ticker BKE, which is a retail company based in Nebraska that sells casual clothing, footwear, and accessories for young men and women in the United States, offering a range of brand name clothing including denim, tops, sportswear, and outerwear. Buckle operates over 400 retail stores in 42 states and also sells products through its website and offers customer services like free hemming, gift packaging, and layaways. Now, while they did cut their dividend during the pandemic and look to be a bit late on raising it, CEO Dennis Nelson in their last earnings call said, "We continued our practice of paying quarterly dividends and also paid a special dividend for the 15th consecutive year." And with that special dividend, you're looking at about an 11.6% dividend yield. Simply Safe gives our company that exists in the land of the mall rats a score of 50, which is borderline safe. And that dividend yield of 4.02% is about 5% below the 5-year average. And if you buy before April 13th, you will get 35 cents per share from the buckle. And again, they were due for a dividend increase in December of 2021, but they have a 6% 10-year CAGR, so definitely keep an eye on that. They had a special payout in January, so likely next January there should be their 16th consecutive special dividend payout. Again, just like Williams-Sonoma, really low free cash flow payout ratio of 35%. Their free cash flow per share of $3.99 can easily cover that annual payout of $1.40. And I also like Williams-Sonoma, that sales growth has dropped to 4%. They do have a little bit of shareholder dilution, not a lot, 48 million in 2014 up to 49.6 million now, just something to be aware of. They too have a return on invested capital of 48%, a return on equity of 74%, which is just incredible. Simply Safe shows a net debt of 8%. Dennis Nelson said in the last earnings call, they have a strong balance sheet and ended the year debt free. And again, I checked on the balance sheet on the 10K from the SEC filing, and sure enough, they have no debt. Alpha Spread gives the buckle an intrinsic valuation of $51.70, about 33% undervalued. And on the worst case, which would be about 5 years of negative growth, still about 14% undervalued at $40.58. So definitely looks like a bargain here. They have strong numbers that are hard to argue with, and during the last recession, their sales actually were up 5.3%, and the recession return was negative 3% on the stock price, while the S&P 500 was negative 55% from 2007 to 2009. And they did increase that dividend during the last recession. So I think as long as enough young people keep going to the mall to buy their clothing, then I think the buckle should be okay. And again, another interesting company that I think you should look into. And lastly, we have a company that after listening to their earnings call, I kept getting the feeling that I was listening to a weight loss cult. So their structure is management, leader coaches, and then customers who work with the coaches and then can become themselves independent contractor coaches. So they have an incentive structure with different rewards like this one, where you can earn a suite to the Optavia convention for the Celebration of Success ceremony. But in all seriousness, if it is a health and well-being cult, they can't be all that bad, right? So Medifast, ticker MED, is a company that provides products and programs to help people live healthier lifestyles, offering a wide range of consumable products that are designed to be nutritious and healthy. These products include items such as bars, shakes, soups, and snacks. They have many different subsidiaries that help them operate and sell their products, including Jason Pharmaceuticals and Optavia. Now they have almost 1,000 full-time employees. They have a 35% 5-year CAGR, which is just incredible. 7 years uninterrupted and dividend growth. Now that dividend of 6.69% is 144% above their 5-year average, and they are buried at the lower end of the 52-week price range currently. Simply Safe Dividends gives them a safety score of 45, borderline safe. So they do pay $6.60 per share per year and $1.65 per quarter, and they just gave a penny increase back in March of 2023. Free cash flow payout ratio 41%, also very, very low. Earnings payout ratio 62%. That $15.90 of free cash flow can easily cover that dividend of $6.60, but just do be aware there could be some reversion to the mean, which could put pressure on that dividend in the future. Sales growth has dropped to 5%. They have been buying back shares, down to 11.3 million shares outstanding, and those sales up and to the right, $1.6 billion. Now they have a stupid return on capital of 102%, return on equity of 80%, nice free cash flow margin of 10%, and no net debt. This one Simply Safe did get right. Alpha Spread gives Medifast an intrinsic valuation of $152, which is about 35% undervalued, and at the worst case, $127, which is about 22% undervalued from their current price of $98.65. Now, Medifast insiders, unlike the other two companies we looked at, have been buying quite a bit of shares, and only 7.5% of the shares outstanding are shorted. Now, I don't know, but to me, they feel like a multi-level marketing scheme, which is where a company recruits individuals to become independent distributors or representatives of the company's products or services. From some of the reviews I've read, it's very expensive and the food tastes like, I don't know, to me it sounds like they have a system that really shouldn't be working, but it is, and here we are. Now, as of this recording, I would only really be interested in Williams-Sonoma. That's just my personal preference. I would love it if you would share if you're interested or if you invest in any of these businesses. Oh, and did you crack that code? If you guessed that they're all part of a consumer cult, you're wrong, I think. Seriously, if you had guessed that they're all debt-free, your prize is getting to watch why I think Medical Properties Trust could be a risky investment in this floating little box next to my head. So if you click that, I'll tell you all about it there.